Question, have you blown out a trading account in the last 30, 60, or 90 days? Have you tried Telegram signals? Have you tried copy trading? Have you tried every indicator under the sun and you're still losing? Please do not quit. Allow me to teach you how to trade in this video. Let's go deeper. Hey guys, how's it going? My name is JD. I teach struggling traders how to finally start to win in the financial markets. Okay, so we're going to jump right in today. But first, I just want you to take a quick look at these YouTube comments so you can see how people have come to this channel and begin to start winning. All right. Now, while these are going through, what I want you to do is grab a piece of paper, grab a pen, because this is going to be the moment that changes your trading journey and you're gonna want to take notes. Okay. And if you're really serious, if you're really serious about winning in trading, you hit that subscribe button right now. Okay. Because we're going to dive right in. I'm going to start from square one. We're going to unmask and unveil and demystify a lot of misconceptions in trading today in this video. So let's get started. Okay, first of all, if you are losing by any of the methods that I said in the intro, it's probably because you've fallen victim to what I call bad common trading knowledge. Okay, most people who are losing in the financial markets do not realize that you're losing because you've been taught how to trade by your competition. Let me say that again. Most people who are losing every day, the 90% of traders who are losing because you've been taught how to trade by your competition. Okay, so big money institutions puts all this information out into the marketplace to teach you how to trade, basically to turn you into a counter trend trader. At the end of the day, bad common trading knowledge turns you into a counter trend trader. All these indicators that they have you use, it makes you counter trend trade. And anybody who is counter trend trading is going to be a losing trader. Okay, so what we're going to learn in this video is how to trade the right way. And the right way to trade is by using price action. So price action is king. Price action is how we win. Price action is what big money institutions, it's the strategy that big money institutions they absolutely positively do not want you to learn how to trade using price action. But that's what you're about to learn in this video. So buckle up. You should have your pens ready. You should have your pencils ready. Got your paper ready. Now, I didn't say hit the like button yet because you're going to do that in the next 15-20 minutes. But again, hit that subscribe. Let's go in. Let's go to the charts and show you this strategy. Okay, guys. So the first thing we're going to look at is our time frame, right? So we're going to be doing this on Apple today. So the very first thing we're going to change is our time frame, and this strategy works on a 1 minute chart. Okay, so we're going to be trading a 1 minute chart, and let me go into a little background information of why I like to use the 1 minute chart. So I learned price action in the futures market, and we were actually using a 2000 tick chart, and the 2000 tick chart is really based on not based on, but the way a 2000 tick the way a 2000 tick chart works is that every tick represents a new contract, a new order. Okay, so every 2000 orders is a new candle. So in the futures market, those candles come very fast. It's a very fast-paced market, but you're only trying to get 1 point, which is called the scalper's profit. So this is a scalping strategy. This is the strategy I'm going to teach you today is based on a scalper's strategy. That's why in the binary options market, we just do a 1 minute chart because they don't even have tick charts in binary options. But if they did, I probably would still go with 1 minute because 2000 tick chart is really fast. Okay. But so that's why we use the 1 minute tick chart, because we're actually scalping. Okay. We're trying to just scalp the market, get in, get out. And we do this by reading the price chart and taking good price action entries. So this strategy, again, we go with a 1 minute chart. Okay, so now that we have our 1 minute chart, let's talk about indicators. Okay, guys, listen, here's the deal. Indicators are a trap, okay? Indicators were created by your competition, all right? Big money has created all these different indicators. They teach you to pair the MACD with the CCI, put on the stochastic, you know, use this histogram to determine if a market is overbought or oversold, you know, a lot of stuff, okay? Listen, you don't need indicators to trade. I know this is going to be a hard pill for many of you to swallow, but the best trading comes from a clean price chart with no indicators. I mean, I understand what you've been taught, but if it was listen to this. If indicators truly worked, right? If all you had to do to win in trading was to put an indicator on a price chart, why is only 10% of traders winning? Let's think about it. Let's look at the numbers, right? If indicators truly worked, why are you watching this video, right? If indicators truly worked, why are you still searching for a way to win in the markets, right? You think it's just a combination of indicators. No, but the combination doesn't matter. Indicators have another name called, well, there's another part to indicators that most people leave off, and it's called lagging indicators. Indicators lag behind the market. Therefore, by the time the indicator gives you the signal, most of the best price movements are already over, or you're going to be late. Okay. Sometimes you can win being late if it just takes off into a great trend, right? Many times you're going to lose because you were late entering. All right. And timing is everything. Timing is a very, very big part of trading. So you need to know when to enter the market, how to enter the market. Okay. And so you don't need a lot of indicators. Okay. And sorry, I left something off too. Thinking about the 1 minute chart again. Here's something else. I'm going to blow somebody's mind. I don't use top down. I forgot what it's called. Top down analysis. Okay. I only trade from the 1 minute chart. All we need to do is analyze one chart. Here's why. Okay. Here's why. I told you we was gonna be going against a lot of bad comment trading knowledge in this video. Here's why you only need one chart. When you're trading price action, all you need to know is what's happening right now. Okay? That's it. We're trading from a 1 minute chart. All right. So I don't need to look at a day chart to try to scalp the market for the next 20 minutes. You see what I mean? 20 minutes of time, a day of time. So I don't need to start to the day and then go from day, 4 hour, 30 minutes, 15 minutes, 1 minute. That's a whole bunch of work for nothing. All I need to do is know what's happening right now. That's it. I need to be able to read a price chart to the level that I know what the market is doing right now. I don't need to know what it's been doing over the whole day. I'm only trying to scalp it for 25 minutes tops, maybe 30 minutes tops. So it doesn't matter what it's been doing all day. The only thing that matters is what prices are doing right now. See, so all this other stuff is just, it's frivolous, okay? Most of these trainings, again, are designed to make you a counter trend trader. And it's just people trying to create education to sell you some stuff that don't work, all right? We don't need top down. All you need is one chart, okay? Sorry I left that out. Had to make that point. Very important point, okay? But let's get back to price action. Now let's go back to the chart and add, I don't even like to call it an indicator, but you get it in the indicator section. So I know somebody's gonna say it's an indicator. To me, it's not an indicator, but let's go grab, I'm not gonna call it an indicator. Let's go grab the 21 EMA. All right, guys, so we're back here. So now let's grab a tool here. I'm gonna call it a tool. I'm not gonna call it an indicator, even though it's under the indicator sections. And it is the one thing you need to be able to trade price action, moving average. Okay, So let's get into it. And we use 21 period. That's just 21 bars back. And we use the EMA, exponential moving average. Save. You know, I'm gonna change the color here. So we, change the color here too. Make it a little bit thicker so you can see it in this video. All right, there we go. So the 21 EMA, all right, we've added it to the chart. Let's talk about it. Okay guys, so one of the most important tools for trading price action is the 21 EMA. Now I know, you know, some of you should already be familiar with moving averages, but all it is the average price, right? So the moving average gives you the average price. But here's how we use the 21 EMA. The 21 EMA is truly our best friend in trading, okay? Because I use the 21 EMA to determine the direction of the market, right? I also use the 21 EMA to see the market cycle, which I'm going to show you later in this video. But it gives me immediate direction. So here's how it works. If prices are above the 21 EMA, we're in an uptrend, okay? If prices are below the 21 EMA, we're in a downtrend, all right? If prices are moving sideways, I take that back. If prices are just kind of choppy looking and the EMA is moving sideways like it's a roller coaster, we're in a range, all right? So, very key point in trading. The market can only do three things. It's gonna trend up, it's gonna trend down, it's gonna move sideways in a range. That's it. Those are the only three things a market can do, all right? So when you get that understanding, then you start to look for, you can start to look for, well, what is the market telling me right now? You know, the 21 EMA is your guide. Again, when we're above the 21 EMA, uptrend. When we're under the 21 EMA, downtrend. If the market is moving sideways and the 21 EMA looks like it's a roller coaster, we're in a range, okay? And so that's very important because when we're trending up and when we're trending down, we trade in a certain way, a certain fashion for price action. Where we're in a range, we trade in a certain way, in a certain fashion for price action. And I'm gonna cover that also more in the video, all right? So let's go back to the trading chart and keep on building on this foundation. All right, so we're back at the chart. Real quick, what I want to talk about next is signal candles, okay? Signal candle theory. You need to understand that these candles mean something, okay? Each candle, a price chart, let me say this, a price chart represents real people in the real world buying and selling assets, okay? And so the size of a candle matters. For instance, if we look at, see these three candles here, 1, 2, and this one right here. These three candles are actually humongous, right? They're much bigger. This candle right here is much bigger than this one, this one, this one. It's much bigger than, man, what, the last 12 here, right? That actually represents something in the market. What that means is that more than likely a big institution put in a whole bunch of buy orders and they moved the market, okay? It takes a lot of buy orders, millions and millions and millions of dollars, depending on the size of the market you're trading in, whether it's a futures market or a Forex market, or a stock market. It takes millions of dollars to create a candle like this. All right. So when you get a humongous candle like this, especially right off the EMA, that's a clear sign that the big money institutions have just entered the market. And guess what we do as price action traders? We trade with big money. If you've ever heard the phrase, the trend is your friend, the trend is your friend, because you're trading with big money, because big money institutions create the movement in the market. You know, us little retail traders, we can't move the market, not unless we pile up together like they did in Reddit and sell the same stock like they did for the GameStop stop last year, right? That's the only way it happens, is that regular people, regular retail traders all band together and do the same thing. Other than that, my little money ain't moving the market, okay? My little money is not going to create a candle this size. But when you see a candle that size, that's a clear sign that big money institutions have come into the market, okay? So we use these candles as signals to enter a trade. But first we have to have a pattern, and we use several strategies for price action. We have second entries, we have higher low, lower highs, we have rally-based rallies, we have drop-based drops, and we have range phase setups. That's kind of the gambit right there, okay? And so when you see big candles, we like to use those as the signal candle. So for instance, we want to see our pattern, then a big candle. Let me show you one real quickly. Right here, we made a high. This is a push down, back up. That's the first entry. Didn't push down again. Almost came to the EMA. When it breaks higher again, we call that a second entry long. But it wouldn't have triggered unless this candle here gave us what we would want to look as a good signal candle. Let me explain to you why this candle here is such a great signal candle. This candle is such a great signal candle because first of all, it broke lower first, which means it trapped everybody who was going short. Everybody who thought this run was over, right, and went short right here, they just got trapped on this candle, right? As soon as they put a sell stop right here, prices kicked them in. They thought they were good, then it reversed on them, so now they're trapped. That's called a trap, okay? So then this candle pushed all the way back up and nearly closed on its top. So let me, and signal candle theory, let me explain to you what just happened. It took a whole bunch of sellers sold this thing to make it drop like this. It takes like double the buyers, double the buy pressure, double the money to make a candle push back up and leave a stem. First of all, made us, push back up, and then to overcome all of those sellers, bombard them with buy orders to the point where it starts to push up and then close on its top and make what we like to call a hammer up, with signal candle theory. This is a hammer up second entry. That tells you right there that there's a lot of buy pressure coming into the market. Big money just entered the market, and we're probably going to continue to go higher. And look what it does. Look what it did. Okay, I'm getting too excited here. It took off. It took off like a rocket, and it worked just like we expect a second entry to work. Okay, so this would have been an outstanding signal candle to go with big money, to trade with big money, to not get trapped, but to go with big money. So that's just a little piece of signal candle theory. Big candles matter, okay? These big candles matter. They're a sign that big institutions are moving money, and you want to move in the same direction, okay? So when you see a big candle, when you see, okay, like you get this big candle here and then this one here, you don't want to go short on this little nothing candle. That's nothing. Look how small it is. It's nearly a doji. It's, you don't want to go short here. But I bet you there's some indicator that probably would have told you that this run was over, time to go short, and a whole bunch of people would have went short here and got trapped. And if you didn't go short here, you would have went short here and you would have got trapped. And if you didn't go short there, the indicator would have told you to go short right here and you would have got trapped. This is why most people are losing, because they're counter trend trading, and they take horrible signal candles like this one, this one, this one, this one, or this one, when the 21 EMA would have been telling you, no, we're clearly trending up. Prices are above the 21 EMA. Even starting from down here, we got above the EMA, went under for a hot second, was right back above it, stayed above it, stayed above it, and stayed above it. We're trending up. This is why the 21 EMA is your friend. When we're above the 21 EMA, that's a clear sign we're trending up. Okay, so that's some signal candle theory for you. All right, just a tad bit, but that can get you started. Pay attention to the size of candles and look out for good signal candles. And typically a good signal candle is going to come with a pattern. Let me show you another pattern. So this was a push down, first entry, push down, second entry long. Let me show you a nice higher low. Here's a low right here. We pushed up, came back. This is a higher low. This low right here is higher now than this one. We call that a higher low, but it doesn't trigger until we get a good signal candle, and we get it right here. Push down, trapped everybody going short again, counter trend trading. Then it pushed up, closed higher than everything to the left, nearly closed on its top, full body, beautiful signal candle to continue the uptrend, and us scalping 1, 2, 3, 4, 5. That's a win. Bang. Okay. That's how you do it. You trade with trend. You take second entry longs and higher lows when you're in a uptrend. All right. And this is another case of a beautiful signal candle. This was a beautiful signal candle. This was a beautiful signal candle. And we know we're going with trend because we're above the 21 EMA. So those are some price action setups that you take while the market is trending up, and using the 21 EMA, knowing a few price action setups and waiting for beautiful signal candles is all you have to do. You don't know indicators needed. I didn't have to go look at the day chart, 4-hour chart, hour chart to know what was happening right now. Okay. I didn't need to do that to look at a minute. I can look at this 1 minute chart and tell what the market is doing. We're in an uptrend. This is people make it people. I'm not going to say people. Okay. The industry is trying to trick you to thinking that trading is hard, to make trading extra super duper technical. If you keep it simple, if you truly keep it simple, you will have so much more success. We're above the 21 EMA. That means we're in an uptrend. I'm looking for second entry longs. I'm looking for higher lows. There's no other trade to look for. That's how simple trading can be when you know how to keep it that simple. Okay. So the next thing we're going to talk about though here is I'm going to give you a quick introduction into the market cycle, because the market cycle is the true missing piece that you need to become a consistently profitable trader, and for you to be able to truly read a price chart. Okay. So let's get into the market cycle. Okay, guys, this is an important piece of trading that I'm about to share with you. Okay. The market, all financial markets, not just binary options, not just the Forex, not just futures. I guess that's covered about everything now, and stocks, right? They all move in a market cycle. All right. This whole world moves in cycles, right? We got a planetary cycle. We have a harvest cycle. Farmers live by a cycle, right? We all go, the world, we got the 4 seasons, right? This world, okay, moves in cycles. And that's great because cycles allow you to anticipate what's coming next, right? We know that summer is coming after spring, right? We know winter is coming after fall. So that's a beautiful thing. So guess what? Here's the secret sauce to trading. Here is the secret sauce. You hear me? Are you listening? Are you taking notes? Here is the secret sauce to day trading. Financial markets move in a cycle. Okay. Call it the market cycle. Here it is in a nutshell. The market is gonna trend. Let's say we're trending up first. It's gonna trend up. You're gonna get a trend break, and then it's gonna retest to a new high. That is a market cycle. Okay. Then when you start to come low, it's gonna trend down. You're gonna get a trend break. Then it's gonna retest to a new low. That's a market cycle. That's how markets move. Okay. Trend break, retest. Trend break, retest. Trend break, retest the new high. Trend break, retest new low. That is how the market moves. Okay. And so the beautiful thing about the way we trade price action is that to be able to see that, all you have to do is use your best friend, the 21 EMA. Now, when I first was taught the market cycle, we actually was taught it by using trend lines. And I know a lot of you know how to use trend lines, and you know, you can understand the theory of when a trend line is broken, the trend may be over, okay? Well, here's the deal. Trend lines can be drawn wrong. It's very, very easy. I mean, it's extremely easy to draw trend lines wrong. That's the only problem with trend lines. I know how to draw them, but I've also been taught to draw them 3 different ways, right? Which way is right? Which way is right? So what I teach, you know, what I teach my students, what I teach here on YouTube, what I teach in my courses, we don't use trend lines. You can if you want, but I typically don't, because what I found out is this: when you see a good trend, the 21 EMA is going to be running parallel with that trend line anyway. So you really don't need it. Just use the 21 EMA, right? Again, the 21 EMA is your best friend. It helps you determine the direction. It helps you see the market cycle. It helps you see price action entries. Man, I guess the secret sauce is really the 21 EMA. People don't understand that. The secret sauce is actually the 21 EMA paired with your understanding of the market cycle. Okay, so let's go back to the chart. I'm gonna show you how it basically runs parallel with a trend line, and just stick to the 21 EMA. Let's take a look. Okay, guys, we're back at the chart. So listen, like I was saying, the 21 EMA is your friend, all right? But let's say you did draw a trend line. I just want to show you how it's basically parallel with the 21 EMA. So it's the same look. So if I take this trend line, and again, they could be drawn wrong. I'm gonna start from this low here. Somebody may say start it from here. See, I mean, trend lines are tricky. I'm gonna start it from here, and then I'm gonna take it up to, and then the next stem would be the point and up to the top. There's my trend line. There's my trend line, right? You notice how it's parallel with the 21 EMA? It's parallel with the 21 EMA. So why use it? So I don't use trend lines. I know that may blow somebody's mind there again, but that's exactly why I don't use them, because it's truly parallel with the 21 EMA. Okay, so now let me show you the market cycle, just if you've never seen it. Here it is right here. I'm actually gonna use the trend line to show you this though. Let me grab another trend line. So let's look at the market cycle. Start from this low right here. We're gonna take it to this low. Take it to that stem. I'm actually gonna take it to the body. It fits better going through the body this time. There it is right there. Let me thicken it up a little bit. I never played with these, so okay, maybe this is it. All right, so you see this, we're above the 21 EMA. We're trending up. We're trending up, okay? Here was a first entry push down. Here's a second entry long. Here was a high, low, push up, higher, low. Both would have worked. Price action, I love it. Anyway, that got me off base a little bit there. Here, we're clearly trending up, okay? Then this is a clear trend break, right? This trend line was broken, okay? So trend up, trend break. Now what do we expect? Because we understand the market cycle, we expect prices to try to retest to a new high. And here it is right here. Boom, retest to a new high. Trend up, trend break, retest to a new high. That is, people, the market cycle right there, okay? Show it to you again, going short. Let me grab a trend line. Okay, here it is right here. Here's the trend line. They love to put this box just right in my way. Okay, let's hit it off the top. There it is. Let's make it bigger so you can see it. All right, we're trending down. We're under the 21 EMA. This is a clear trend down, right? Here's the trend break right here. The trend line was broken. The EMA was broken, which is why I don't use trend lines. But we got a trend down, trend break. What do we expect? Can anybody tell me? We expect prices to try to retest to a new low, which means we expect prices to try to get lower than this point right here. Let me put a horizontal line here so you know what I mean. This was the low. Right here was the low. This is where we bounced. This was the low. It's also, you know, pretty level. You kind of see the support here. We bounced once, twice, 3 times, right? But now that we're trending under the EMA, we got the trend break, and we're expecting a retest to new low to get through here, and it does. Boom, just like that. All right, that is the market cycle, people. Now let me show you some trades from right here. Push up, first entry, push up, came down, second entry short. You take that right there. Then you got a high, push down, lower high right here. Beautiful signal candle, closed on its low. Big candle showing all the rejection. 1, 2, 3, 4, 5. That's another win. So we got a second entry short, then a lower high, and then you just keep taking lower highs all the way down, working with trend. And there's a bunch of trades right here. I mean, this little run here gets you about maybe 5, 6, 7, 8 wins in a row. Easy, nothing to it. You know why? Because we understand the market cycle. And I mean, I just can't make this stuff up. I can go show you this on chart after chart. I'm not in this video because I don't want the video to get that long, but you can take all your indicators off your chart, slap a 21 EMA on there, and go look for prices under the EMA, trending down just like this. Look for the trend break and see the retest in the low. It happens all the time. I mean, it happened again right here in the same drop. Let's go from here. Go from here. We got the trend down, right? We were trending down. Look how snug this trend down was. Prices was falling, falling, falling. This is a clear trend break, right? So where would we expect the new low to take place? We would expect to retest to a low lower than this point right here. This was the low. We got the trend break, and we expect a retest the new low. Boom, right there. Trend down, trend break, retest the new low. That is the market cycle, okay? That is the piece. That's probably the piece of trading that you have been missing, that has been causing you to not be in the top 10%, because you do not, or you have not had the knowledge, right? You have not had the knowledge to get wealth and the understanding that markets move in a market cycle, okay? Markets move in a market cycle. They also move in the ruler too, but I'm not gonna go into that in this video. That's in the course, but it's the market cycle, right? If you understand the market cycle, you'll be well on your way to beginning to win and trade correctly. This is how you trade correctly. And the beauty of this price action trading is that you take it anywhere, right? Now I'm doing it here in binary options, but man, you can take this anywhere and begin to win. Okay, so let's keep moving. So the next thing I want to do, so you can see our trading strategy that we do here is, so let's see, make sure let me check off things. We got the 1 minute, we're on a 1 minute chart. We got the 21 EMA on here. So the next thing we need to talk about is the expire time, because we are doing binary options. And so again, this trade is a scalp. Okay, this trade is a scalp, but what I have found is I've tested plenty of time frames. Okay, I mean plenty of, I always say it wrong, expiry times, expiration. Let's go with expiration. I've tested plenty of expiration times, right? When I first got started, I started on a minute chart. Okay, and it worked. You know, it worked. I was able to make money. But my wife was kind of struggling at the 1 minute chart, you know, because she would hesitate sometimes. And man, when you trade a 1 minute chart, it can't be no hesitation. You know, you got to be in. You have to make sure there's a lot of momentum, because you need that next candle to go in your favor, right? And so I really prayed about it. And I asked God to help me to see what I should do. He actually moved us to 3 minutes, right? So then we were doing 3 minutes for quite some time. And the 3 minute is a very solid expiration time for a scalp in the binary options market. Okay, but then I started to take more of a swing trade setup, which I'm going to show you here in a minute. You know, so hey, if you need to go get some water, understand it's been a lot. We almost need to take a recess, right, and come back. But I'm going to show you the strategy that we're using currently. And so I started it actually at 10 minutes. Okay, we were taking a 10-minute swing trade out of a Fibonacci retracement zone, which we have named the sweet spot, because the trade is that sweet, baby. Okay, I'm gonna kid you not, it's sweet as candy. But and And I started that at 10 minutes. So I was doing it at 10 minutes, but I started to notice that I would be up, and then man, I was losing on the last few candles, and it started to happen too consistently. And so I had to go back to Yahuwah again, put in more prayer, like, oh Lord, I don't know, what should I do? And I was actually talking to my dad too. You know, it's good to just run ideas off of other people. And I was like, you know what? I'm going to try 5 minutes, the number of grace. Let's go with 5 minutes. And actually what I was able to do, because I record all my videos, and you'll see some live trade examples I'll put at the end of this video, because because I record all of my trading, I was able to just go back through the video and see what would have happened at 5 minutes. And I found out that without the shadow of a doubt, for this particular trading strategy, 5 minutes was superior. So you can use any time frame you like, as long as you're reading the price action. You know, that's what's most important. In my personal experience in testing, 5 minutes won out as far as expiration time. Okay, I know some people, that's too long to be in the trade. Some people, that's too short. They like 10, 15 minutes. Now with the sweet spot trade, I'll tell you, to me, 5 minutes is up. It's the money. It's the money time. You probably can go 5, 10, 15, 20 and be fine. I personally like 5 because my trades trigger so close together. I found also that I was losing out on entries because of 10 minutes, because of 15 minutes, you know, trying to wait for that one to finish. I may have missed 4 or 5 entries. For instance, I mean, just look at this. Like I pointed starting here, this is the first entry, push down second entry. That's one trade that would have worked. But then a high, lower high trigger right here. Now, if you wait for 10 minutes, you may not enter here, right? But at 5, I can enter here because this is 1, 2, 3. This is candle 4. I know I only got one more to go, and I'm probably going to win. So I go right here again. Then you get another high, push down, lower high. Beautiful signal candle right off the EMA. Close on this low, close lower than the bar to the left. This is a great entry. So if I'm 10 or 15 minutes, that's 3 entries I just missed. And this one would have worked too. And then you got another one, high, lower high right here, big candle. That one would have worked. So again, look at all these entries you would be missing if you're at 10 minutes, 15 minutes. But if you're at 3 or 5, you catch all of these. I mean, this is 1, 2, 3, 4, 5, 6, 7. That's 7 in a row, people. Actually 8. 1, 2, 3, 4, 5. That's 8. That's 8 in a row right there. So that's why I do 5 minutes. You know, at 5 minutes, I take every one of these. At 3 minutes, I take every one of these. You know, but if you were at, you know, 10 or 15, you would still win. I mean, if you take this first one at 10, you win. You take this first one at 15, you win. You take this first one at 20, you win. But you may only have got one trade when really there was 7 wins. Because I just want to point that out because again, this strategy, I learned this strategy scalping the futures market. So this is a scalping strategy, even though we're taking kind of swing trades and we're going with the trend, and the trend may dish out a whole bunch of wins. We're scalping. So really, I still only want to be in my trade 5 minutes. I found that 5 minutes works. Do what you want. I just wanted to lay that out there and give you the why I do 5 minutes. I've tested 1, I've tested 3, I've tested 5, I've tested 10, and I'm telling you, I'm in love with 5 minutes. Okay, so that's my spill on that. All right, so what do we have here? We're trading on a 1 minute chart. All right, let's recap. We're trading on a 1 minute chart. We're using the 21 EMA to give us the direction of the market. Okay, we're using price action entries to trade. We're taking good signal candles as our filter to know when to enter the market. Okay, and we are reading the price chart by looking for the market cycle, trend down, trend break, retest. Okay, so the strategy is this. Many times you're not gonna see the first leg. You know, the first leg of the trend, you know, you don't know. A lot of times it's coming out of a range, just like here. This was coming out of a range. By the way, if you don't know what a range is, look at the EMA. Look at the EMA. Let me help you see this range right here. This is the bottom of the range. It's more kind of like this, to be honest with you. Here's the top of the range. Okay. Here's the top of the range. You see this range? Boom. That is a range, people. That is a range. But let me explain something to you about this. Here's another kicker. Here's another part of bad common trading knowledge. Most trading strategies will teach you to go right here. They teach you to take breakouts, right? Most people are trying to catch a breakout. So they would have bought here, they would have bought here, they would have sold here, they would have sold here, they would have bought here. You see why you've been losing? You see why you've been losing? Because big institutions who put out bad common trading knowledge put information out into the market to trap you. This is why 90% of traders are losing, because they're using breakout strategies, thinking that we're gonna break out of this range, No, we're not breaking out of the range. You know what you should do in this situation? You should fade the range. Okay. What that means is when it looks like we're about to break out, do the opposite. Right here, let's look at it. This is nothing but a first entry, second entry short off of the range. We call this a range fade. You take this, that's easy money. Also, here's another thing about the 21 EMA. Okay. Very, 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 very important thing about the 21 EMA. Man, I'm teaching today. This is all coming together beautifully. Here's a very important tip about the 21 EMA. It is a moving average. I think we've covered that, right? The 21 EMA is a moving average. So when you're a long distance away from the 20 EMA, like right here, we're so far away, it's gonna pull back. Why is it gonna pull back to the 21 EMA? Because it's a moving average. It's in the name, moving average. So if prices are too far away from the 20 EMA, it's gonna pull back to it. So when you're way up here, when you see this green candle and you see we're this far away from the 21 EMA, you don't take a breakout right there. You are throwing money out the window to take a breakout, to take a trade period going long this far away from the 21 EMA. Okay. If anything, you take it right here off the 21 EMA, then you could win. But you take, so let me say this, write this down. Your very best entries are on, off, or around the 21 EMA. Okay, I'll say that again slowly. Your best entries are on, off, or around the 21 EMA. Once you're way up here, you do not buy. You take a short expecting the 21 EMA to act as a magnet, and it did right here. Then what do you get? You got another one right here. Start from this low right here, push up, first entry, push, second entry short right there. You take that one. 1, 2, 3, 4, 5. Easy money. Why? Because we were too far away from the 21 EMA to be buying. That is a losing strategy. Breakout strategies are a losing strategy. When you know that you're in a range, you take range fades. When you're at the top, you sell. When you're at the bottom, you buy. Let's look at it from the bottom, from this top right here. Push down, first entry. Wait a minute. Well, this is kind of choppy. What you really got here is a low, push up, higher low. Big signal candle broke back into the range. Still got a little room to the EMA. Coming off the bottom of the range, you buy there. Boom, easy money. Coming off the bottom of the range, you buy here. Boom, easy money. Coming off the top, again, they tried to trick you. You see this candle, you think we're going. Look how far away from the EMA we are. Nope. Nope. Suckers bet right there. Okay. This is how they get you. They've pumped all this bad common trading knowledge into the marketplace. They got you taking breakout trades that don't work. They just don't work. I was about to say they work just enough for you to keep taking them and losing, but the breakout trades don't work. I mean, stop taking them. Stop taking them. If you're in a range, fade the range, go the other way. Okay. Go the other way. That's my tip right there on. That's how you trade. That's how you trade the range, people. That's how you trade the range. Okay. So that threw me way off. What was I about to talk about? All right. Do I need a break? I might need a break. No, I'm just playing. Let's keep it going. Let's keep it going. I hope you guys are enjoying this value. Hey, can I get a like now? It may be time to hit that like button. Let's take a break. I'm gonna drink some water here. I'm gonna drink some water. We're gonna keep this thing going. let's hit that like button for me. Okay, let me see my notes, see what's next. Okay, so one more little tool we're gonna put on. This one is a bonus. You do not have to do it, but it could help you see the legs easier. We're gonna add a zigzag indicator. Okay, and this isn't on every platform, but it is here on Pocket Options. So we'll add the zigzag. I think we'll add the zigzag. Oh, not start. We want to add it. We'll add the zigzag so you can see something. So this zigzag indicator, this is what it does for us. You can easily see the legs, okay? So the market cycle, again, is trend down, trend break, retest a new low. What goes with that is the rule of two. Let me go on and just throw it out here anyway. The market moves in twos, okay? So it moves in legs of two. This is one leg, push up, second leg. So the zigzag indicator, for me, it just allows me to see legs real quickly so I can analyze the market faster. That's it. I don't change. I just slap it on. I don't do any adjustments to it, nothing. It just allows me to count legs quicker. Okay. So when I see this leg and then I get over here and we finally make it under the 21 EMA, I know it's go time. Okay. And I'm looking for this first entry, second entry short, the trigger's right there. I take it and that starts the winning. That starts winning time. Dame time. Y'all heard about Dame time? The basketball player, you know what I'm saying? Dame, when it's Dame time, hey, when you get that second entry short under the EMA for a second and you're thinking you're about to get that second leg, that's when winning time starts for binary options traders, for futures traders, for Forex traders. Because again, this strategy can be taken anywhere. You can use price action trading is for anywhere. Okay, so let's talk about the rule of two real quick. Okay, guys, so the market moves in twos. I really can't tell you why, okay? But I'm gonna give you an educated guess. I'm gonna give you an educated guess on why the market moves in twos. What I believe to be the case is that big money institutions just like to put orders in twice a day. Either they like to put orders in twice a day, or for whatever reason, say they split them up. They're gonna put 50 orders in and 50% in and another 50% in. This is just my educated guess. I don't know, right? But what I do know is that this is what I think happens. Big money institutions put their first bundle of orders in, right? And they begin to move the market. Remember, us retail traders, we don't move the market, okay? It's the big money institutions who are moving the market. And so when they put that first order in, the market starts to go. And whether they bought or sold is the direction that we're going in, okay? So let's say that they put the money, they put their first order in and they went long and prices start going up, okay? Here's the deal. This is my opinion. I don't think they want to put that second order in again while prices are still climbing, right? They want to get in the market at a better price. So they put their first entry in, the market starts climbing, and then all of those counter trend traders that they've taught, that they've trained out in the marketplace with bad common trading knowledge, they start counter trend trading, which brings the price back down, okay? And then big money waits till the price gets down to another level where they can put their second order in at a better price. Remember, I mean, in binary options, you're so used to just hitting the buy button or hitting the sell button that you're not really paying attention to the price of these assets. But in the real markets, you know, in Forex and futures especially, we pay attention to the actual price, you know, of the asset you're trading. And so big money institutions, they want to get in again at a better price to fill the rest of their orders, right? So they go up. All the counter trend traders that they've trained over the years start the counter trend trade and bring the price down. Hopefully you win in time and get out in time before they put their second order in to trap you, right? And then you get the second leg of the market cycle. That's just my theory. I can't prove it, but you trade long enough, you'll see that the market moves in twos, and it happens all the time. Trend up, leg one, trend break, and that trend break normally has two legs down too. The market moves in twos, and then retest the new high, leg two. You have to just trade it enough to believe it. All right, so let's move on. All right, so now we're getting to some serious situations here. So we have a 1 minute chart we're trading on. I've gotta keep this recap going. We're using the 21 EMA. We're taking price action entries with good signal candles that are triggered with good signal candles. Okay, we use the zigzag indicator just to count legs quicker because the market moves in twos. So if we can see the rule of two quicker, it helps us. It also helps you when you're just scanning, right? Because you only want to trade, right? This is a scalping strategy, but it's also a trend trading strategy. So you only want to trade with the trend. Again, the trend is your friend until it bends. So you only want to trade with trend. So what I do is I just scan, right? I'll come over here and I'll just scan until I find, you know, the market cycle in a spot where I want to start trading it. If it's ranging, I ain't messing with it. You know what I'm saying? But if I can see two legs back, I'll know like, oh, here's the one, you know, kind of like, yeah, this one, or no, not like that one. Got excited for a second, thought I found one, but that's what I'm looking for. You know, I'm looking for a nice crispy market cycle. But let me go back to Apple for now. So yes, so I'll just scan. So that's what the zigzag does. It helps me scan. Now, here's another part. Remember I said that the big money institutions, they like to put in a big order, right? Then they wait for prices to come back. Here's another, man, this secret here. Whew, this secret sauce is so secret. I hope don't nobody come kick in my door to keep me from telling y'all this. Here's the deal. We use the Fibonacci retracement tool to identify what we call the sweet spot. Okay, so let me walk you through this. We're gonna grab the Fib tool, which is on every platform for a reason, because it's the most important tool in trading. We take it to the bottom where we can see the trend start. Trend starts here with Buddy EMA. This is where the trend starts, right? Then we take it all the way. If we're going long, we put, let me slow down. If we're going long, we put the 1 at the bottom. We put the 0 at the top. We do it like that for a very specific reason, because we're looking for a 50% retracement. Okay. Markets moves in twos, market moves in a market cycle. But many times that market cycle, that move back, that correction leg, that counter trend leg that most people are trying to trade, it comes right back to the 50% zone, because, you know, market had moved up. And when it comes back to 50%, that's where big money institutions will put in their second order. And here's why it happens so consistently. All right. Now this is, man, I mean, I can't believe I'm getting this away for free. I can't believe I'm about to tell you this for free. This is why it happens so consistently, because big money institutions, they don't put in trades like us, right? You know, Chase Manhattan, BlackRock, you know, these big banks, you know, Bank of America, they're not putting in trades one at a time by hand. Let's think about it, right? They're trading for, they got billions of dollars of assets, some of them trillions. BlackRock got trillions. They're not putting in orders one at a time, okay? What they're doing is they are using what are called automated trading robots, okay? And these automated trading robots are designed, hear me out, write this down, this is life-changing information. These automated trading robots are designed to use Fibonacci. They're programmed. Let me say programmed. They're programmed with Fibonacci retracement zones as the baseline. So many times, once prices get to the 50% 618 zone, they're going to put in orders, which is going to turn the market. And that's pretty much where that second leg many times starts. So if we just mark up that area on this chart right here, here's the 618, here's the 50%. Prices worked his way down, got to the 618, and then came back up. Now this one didn't turn and keep going, but here's a low, push up, higher low. I would take this right here. So I can, and then here's another one. 1, 2, 3, 4, 5. I could have got 2 wins on this push back up. Now it wasn't 7, but just understanding that they like to turn the market in this zone. Hey, I could have grabbed 2 quick ones right there, right? That's better than a lot of people can do. So What we do is use the Fibonacci retracement to find the sweet spot. So we actually call this, I'm gonna take this off. We call this zone the sweet spot. Excuse me. We actually call this zone the sweet spot. And many times a beautiful run will start right out of this sweet spot and just keep going up. Okay. So like I said, that wasn't a great example, but that's typically what you're looking for. And it happens all the time. Boy, Apple ain't looking too hot with it. Let's find one for a good example. Oh, I know I can find one. Euro been looking real crispy. Oh, this one is about to do it. You see this? If I was trading this or thinking of trading this, I would start at the 1, put the 1 at the bottom. If we was going short, it'd be reverse. Come to the top. Okay. We got a trend down, trend break. We're retesting to a new low. Look where we are right now. We are smack dab in the sweet spot right here. Let me turn this white. I want you to notice a few things. First of all, notice how far away from the EMA we are. I also want you to notice that it just happened to stop right here at 618. I mean, it just happened to stop right there. Also from this top, this is a push down, first entry, push, push, push. This will be a second entry long if it breaks higher. Where are we at? We got 5 minutes, 92% locked and loaded. I'll tell you what, it breaks higher, I'll take this trade right now. But this would be what we're expecting, because we're expecting prices to turn right here and start a beautiful leg up. Now, if it doesn't always do it. Hey, it's trading, right? Nothing is 100%. But if it did, then we go. Okay, so this may be turning into an else because it's breaking a lot. This is a nice, strong push. Again, you see the EMA? See how far away we are? Remember, the EMA is a moving average. So at some point, prices is going to pull back to this EMA. Okay, so this one broke out pretty strong. This one is what I would classify as an else. I have another strategy called if then else. If we break out, if we don't stop here, it may be a no-go, right? Nothing's 100% trading. And it may be trying to make the market moves in twos. It may be trying to make another leg about the same distance as this one. And it's just not quite there yet. It's just not quite there yet. But we'll see. I'm actually going to start this up. Let me go to the Euro USD. See if we can see when it has worked. And it goes, you do a lot of scanning. We scan the market. That is a major benefit of binary options market. You just keep scanning, okay, until you find what you want to trade. This one kind of did it. Trend down, came back. This is probably 50%. Then boom, boom. Let's see. Going short, we put the one at the top. The bottom at this point would have been here. We came, touched the 50%. Look at that. Touched it, and then 2 legs down to get another leg of this distance. There you have it. That's the market cycle. That's the sweet spot working right there. Let's see what this audience doing. Oh, nope. I was going to take a trade for y'all, but nope, that's an else. We're too far out of the sweet spot. It didn't turn where we expected. And hey, we don't jump on falling knives, right? Don't jump on falling knives. This is why this is beautiful. There are rules to what we do to keep us from counter trend trading. All right. So let's go back to Apple. and finish up here. So that's the Fibonacci, and I basically just explained the sweet spot to you also. Oh, look at there. Now this one broke out, but look, we have come back into the sweet spot. Too far from the EMA to go long right now, but I would expect from here for prices to continue to test this high, test this high, test this high, because the overall dominant trend was up. Okay, overall dominant trend was up. So now you have to wait until you get a good price action entry to go long. Let's look at that audio again. Oh yeah, it's out of pocket. And that's the beauty of price action. You know, we have rules. We have rules that can keep us from taking bad trades. Here's a low, push up, higher low. So what I would be interested to see here is we just now got above the EMA. I would be interested to see if prices stay above the EMA. If it doesn't and breaks back under, we're still going lower. Again, simple rules that keep you out of harm's way and help you take good entries, good trades. But now if this candle hammers up off of the EMA, we would have a target of here. Here, we would be expecting it to come to the top of the sweet spot. But no, look, we got a big candle under. So hey, another abort. Hey, I ain't got to put it, no harm, no foul. I can read the price chart and know it's not go time, right? Beautiful, beautiful way to trade. But I'm still will watch it though. I mean, we got to see if it's going to stay under the 21 EMA or if it's going to give us a huge candle to let us know that big money is about to take a shot. Let's go back to the audio real quick. Oh yeah, this boy's trending down, baby. So what's happening? Trend down. This is a very weak trend break. So it's just still dropping. I mean, when you got only a one candle trend break, nah, it's too weak. We're still dropping. This is just a beautiful trend. And it's actually, the action may be more like this. If you drew the fib from, oh, now my screen want to do some weird stuff. From the top here down, that probably hit 50%. And now you're just in a great trend, right? You're just in a great trend. It didn't turn here. Go back to Apple. Apple was through. Okay, so sorry, I wanted to get a live one for you. Let's take another look over here. Some more possibles. It's a weird time of day, so that's why everything is really choppy. It's a Friday afternoon. Oh, this one probably has already triggered. Pound Audi, look. This one is triggering, but it didn't come all the way back up. Now you have to find something you want something really clean, something that you don't have to guess at. And that's the beauty of pocket options. Actually, you can just scan through till you find the perfect setup or the perfect market condition. I really should say. And if you don't find the perfect market condition, you don't trade. It's, as simple as that. But when you find the perfect market condition, you take it with confidence. Like I say, it's a weird time of day. We're not getting anything. American Express don't have anything to offer. Boeing, no. Intel, and I can just scan, and I'm just looking for the rule of two. I'm looking for the market cycle. I'm looking for some strong legs. That's a range. A lot of ranging going on. Yep, a lot of range going on. This one we've already missed. If you draw the fib from here, start it right there, put it down to 0, trend it up. It overshot the 618, but now look what it's doing. Came right back through it. Now you got a nice trend down, and it's probably coming to test here and here. So that one we missed. Let's look at that Audi again, see if it pushed up. Nope, can't do it. It's trending down strong. And that Apple. Nope, Apple can't do it. Stayed under the EMA. Okay, so that's gonna do it. We take price action entries out of the sweet spot on a 1 minute chart on a 5 minute expiration with trend at all times. Okay, so what we're gonna do now is I'm just gonna show you a few examples of some trades that I've taken using this strategy. Okay, and if you need to truly and want to truly learn how to trade the markets, all right, want to find success in the markets, okay, take a look at my price action trading course. I'll put a link in the description of this video. It's everything that I put in this video. We go deeper in the course. You need to learn how to spot a second entry. You need to learn how to spot a higher low. You need to learn how to spot a range fade. You need to learn how to spot a drop based drop and a rally based rally, which we didn't have time to cover. All of that is in my price action trading system. That's not going to just teach you how to trade binary options, but it's going to teach you how to trade in any financial market you pick. All right. So I hope you have enjoyed this training lesson. I hope you understand everything that I uncovered for you about how and why you have been losing and how you can turn that around today and begin to increase on the sudden. All right. So check out these examples and I'll see you on Wednesday. Bye-bye. Thank you for watching this price action training all the way to the end. If you want to see more price action examples, check out this video right here. My name is JD, and as always, I wish you increase on the Sutton. Bye-bye.